My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. I'm here to make friends, just trying to make a little money. My job is not to entertain, but to educate. Well, I do a little entertaining. Come on, let's get it together. Call me, 1-800-743-CNBC. Tweet me, Jim Cramer. Yes, I am excited about this market. And I'll tell you why. It's not just because we've now had 8 straight days of up. 20 years ago today, Google came public at a split, unadjusted price of $85 a share. On its first day, Google closed up 18%. Many traders, they thrilled at the pop. They took the gain. In retrospect, one of the greatest mistakes of all time. Do you know that Google stock is now giving you a 7,736% return versus the S&P 500 slightly more than 600% with dividends? It's a reminder of the wealth individual stocks can make for you, can give you versus the indices when you pick the right one. And I'm telling you, they're not all that hard. Did you know how to Google? So I think it's time to defrock the average, at least for a day, okay? Even if it was another good day for them, with Dow gained 237 points, S&P jumped 0.97%, NASDAQ folded 1.39%. Specifically, we need to talk about the short term of the market versus the long term of the stocks. The short term setup's not so good. We're on a real winning streak here, as I mentioned, 8 straight days up, the longest since November of last year. 93% of the stocks, the S&P 500, are up, truly impressive. All since that Monday where the market fell apart because of the yen carry trade. It imploded and led to a wave of forced selling in this country. Sell. Which in turn caused people to panic. Hey, how many times have I told you panic's not a strategy? We've been pretty much straight up since that panic. Unfortunately, the market gets a little perilous when we're what I call overbought. Now, I measure overbought with the trusty Market Edge oscillator. Same one I've used since 1987. Do you know it's never let me down? The oscillator is based on 0, meaning the market's in neutral territory. When it goes to -5 or lower, well, guess what? You have to buy because we are oversold, meaning there's too much downside pressure. When it goes to +5 or higher, you got to sell something. Today, after the close, we learned that the oscillator was a very overheated 7.26. Way too hot for this guy. So we've been raising some cash for the charitable trust, mainly by taking losses. You got to subsidize the winners with the losers. You can't do the opposite. Painful, but necessary, and more on that later. When the market goes up in a straight line like this, you end up in what I call a fraught situation. That's why we need to be a little more defensive. Because when the oscillator reaches overbought levels like now, the next move is almost always down. That's the short term, though. What about the long term? Unfortunately, they are very cross purposes right now. On this, the 20th anniversary of the IPO, I want you to consider the saga that is Google, because I like the saga so much. It makes me happy. When it came public, it did so via called a Dutch auction system, which favored the buyers over the sellers. You got a terrific price if you managed to snag a piece of it. I remember mentioning on air that I thought the Google was worth about $300 that day, a price so high that our lawyer called me in to ask me how I came up with that number. I said I would have used $500, but I was being conservative. The problem for so many investors is the crossroads we find ourselves in right now. When the market is overbought, you don't want to find yourself owning too much stock. But at the same time, you don't want to give up on a great long-term winner because of short-term pain. We own Alphabet, the successor to Google, for the trust, and frankly, we don't really care for it. But we don't care for it in the current iteration. We didn't like the success of the Justice Department's lawsuit against the company as a monopolist. We don't like they never talk about their triumphs like YouTube or Google Cloud. We have no idea how well the NFL package is doing. We can't be sure that Google's base search platform won't be usurped by the various artificial intelligence bots like Meta AI, my favorite. We fear the next Justice Department case, which calls into question Google's ability to be on both sides of an advertising exchange. Something that made these guys fortunes, leaving the advertisers, some people think, in the dark. That's what the Justice Department says. A win by Justice would be a devastating blow for Alphabet, worse than the loss over the payment to Apple to be the default search engine, the one that earned them the title monopolist. Plus, it seems that every time management speaks on a quarter, there are new wrinkles that we don't like. But the stock's been a huge winner for us. I mean, huge. We've owned it through the travails of the last year and the year before that, and even before that, and I imagine we'll keep owning it. Why? Because ever since Google came public, it's been able to reinvent itself repeatedly. Originally, it had no cloud business. Then in 2019, Thomas Kurian came in, took over the reins. I knew him, his reputation as brilliant, an amazing operator. He told me he'd have a big cloud business fairly shortly. He seemed to think I'd laugh at that projection, but I didn't, because that's Google, always coming up with something new. Sure enough, 5 years later, Google Cloud Platforms on a $42 billion run rate. The unbelievably fabulous Ruth Porras moving from her CFO job, now going full-time as President and Chief Investment Officer. What happens when she leaves the job? Well, how about they go ahead and hire Anat Ashkenazi, the incredible CFO of Eli Lilly, a brilliant pickup. This is what Google does. Against this, we have the short-term possibility of a squall that will make people sell the stock because they refuse to take the pain. They can't take the pain. So many investors want to avoid the next downdraft that you almost never see anyone with anything like the 7,736% gain that Google's given you since it came public. This tug of war is a microcosm of the entire market. For example, NVIDIA just had its biggest week in ages, up 19%. I expect this short-term peak. But what happens? This morning, Goldman Sachs reiterates its buy rating, saying it sees a compelling risk-reward going into NVIDIA's earnings next week. So the stock closes up $5 or 4.35%. I'd love to take profits for the trust in the overbought moment, but individual stocks are the true vehicles of wealth creation in this country, not the S&P 500, which is why I'm less willing to lighten up on the best operators. And NVIDIA, despite all the sturm and drang about the stock, is an amazing operator. Same with Amazon. People hated the last quarter. Lots of chatter about a tapped-out consumer. Today, Morgan Stanley comes out and says there's hope for same-day consumable sales. They're going to change their habit forming wildly. Next thing you know, Amazon's making a comeback. It's up 18 points from where it fell after the so-called bad quarter. Microsoft up 3. No particular reason, but I bet you we find out tomorrow why. We also got a hugely positive note from Melius about how markets ignoring Apple's bountiful cash flow. We had another firm talk about the stock's expensive, and it is, unless you consider the cash flow, not the earnings. The Melius piece, penned by the irrepressible Ben Rice, just made so much sense that you know you need to strap yourself to the mast so you don't feel compelled to sell your Apple stock when the market gets overbought with an overbought sell, gets overbought as it is now. You see where I'm going with this? The tech titans, the hyperscalers, the colossus portion of the market. Yes, the mega stocks. They just bite you every time you sell. But the short term says sell. To me, that means it's time to get into the bunker and accept the acceptable losses that you can't avoid. These stocks are just too good to let go. Bottom line, as we go into the possible maelstrom, and I'm giving you that, I need you to remember the return if you bought Google 20 years ago. I'm going to say it again. An incredible 7,735% gain that came from a mega cap stock, not from the index. A gain almost no one captured in its entirety. Why? Because they rang the register too often on the way up. When you're dealing with truly great companies, not the indices, but the companies themselves, I sing the praises of. The real risk is that you panic and get shaken out. I challenge you to be able to handle it. Let's go to Lori in Pennsylvania. Lori.
Hi, Jim. How are you?
I am good, Lori. How about you?
I am well, thank you. Before I ask my question, I just wanted to say thank you for everything you do. You really help us little guys out, and we appreciate it a lot.
Thank you very much. Thank you.
Yeah.
Thank you.
So you're welcome. I wanted to ask you, we have Kellanova from the spinoff, and I'm trying to figure out what to replace it with. We're going to hold on to it until Mars buys out, but I can't figure out what to replace it with.
Oh, you just take the gain. Just take the gain. Move on. It's a great win. A lot of people didn't have it. Lego my ego. I knew the guy who helped test that thing. I always thought it was crazy. And that was now 40 years ago. It was one of the biggest winners of all time. Can you believe it? Let's go to Robert in New York. Robert.
Hey, Jim. How's everything going?
Not bad, Robert. How about you?
Good. Pretty good, Jim. If you recall, I sang happy birthday on your show to myself. And I was pretty good, but you said don't quit my day job.
No,
so I didn't quit
I know.
My day job.
You didn't quit your day. You didn't quit it, did you?
I didn't. You know what I did? I went out and I bought a dog for my birthday, okay? And I was going to call it NVIDIA after your dog, but I didn't want to do that because I didn't want to copy you. So I called the dog Cramer. I called the dog. The dog's name is Cramer. It's a small little dog. And I was able to buy that dog because you made me money in the market, okay? But anyway, so I went to different stores, pet stores. Nothing really intrigued me, overpriced. So I started seeing all these boxes in all these apartment buildings of Chewy. And I knew I owned the stock. And I got to tell you, the stock has been moving up like 22%. And if you recall, you recommended this stock a while ago and said, this is a good one.
I'm
great
at
CEO.
$19. I was eating
know,
my
and I
Blue
bought it at
Buffalo. I had just
19.
had my Blue Buffalo dinner when I did that. That stuff tastes good. I don't know if you use it. It's got an American flag on it, too. You can eat the American flag. I like Chewy. I think it's going to higher. I think it goes to the 30s. And I got to tell you, I like this Farmer's Dog thing. It's a treat. I use it on weekends with my tomato sauce that I make on Twitter. Anyway, happy anniversary, Google. I love pointing this stuff out. And thank you for reminding us of the wealth we can gain, not from the indices, but from individual stocks that you and I all know because we Googled every day of our lives. You just need the willpower to stick with it. Man, like tonight, Palo Alto's on the move after the report. I'm sitting down with the CEO for post-earnings exclusive. Then I'm digging into a company whose shares are up a whopping 700% over the past 2 years. Probably never heard of it. Oh, yeah, S&P. I'll reveal the name and whether now may be the time to buy. Hey, listen, Cardinal Health's coming on. They lost one of the largest customers in April. Didn't even blink. What a great CEO. I'm going to talk to him. I want you to stay with the Farmer's Dog, Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.